Welcome back to the Daily Crypto Roundup. Coming up today, we're looking at a fresh intraday pullback across crypto markets, with Bitcoin easing back toward key support as ETF outflows, profit-taking, and leverage resets drive price action. We'll cover what's happened over the last hour or so, why analysts say this move looks technical rather than fundamental, and how it fits with the wider set of stories developing today. We'll also look at updated institutional activity, including fresh reporting around corporate Bitcoin accumulation and expanded crypto product filings from major banks. And we'll address a broader question that's come up repeatedly: why certain geopolitical headlines that would normally shake markets simply haven't had the same impact this time. Before we get into it, just a quick reminder that the XRP giveaway is due this Friday. As always, all you need to do to be in with a chance is get involved in the comments, and we'll announce the winner at the end of the week. And if you're enjoying the show, make sure you're following or subscribed, and if you can take a moment to rate the podcast 5 stars, it really does help with discovery and getting this out to new listeners. Right? Let's take a look at where the market is sitting right now. Bitcoin is trading around $90,600, after slipping slightly over the last hour following a steadier session earlier in the day. Ethereum is sitting near $3,100, broadly tracking Bitcoin's movement. XRP is trading around $2.17, slightly softer, but still holding recent levels. Binance coin is trading near $900, continuing to move sideways. Solana is hovering around $136, consolidating after recent volatility. Cardano is trading close to 40 cents, still range-bound. Dogecoin is sitting around 15 cents, modestly lower on the session. Avalanche is trading near $14, under pressure alongside broader altcoins. And rounding out the top 10, Tron is holding around 30 cents, relatively stable compared with the wider market. Now, let's get into today's stories. The dominant theme today is the intraday pullback we've seen over the last hour or so. Importantly, this move did not follow a major negative headline. Instead, it appears to be the result of a combination of positioning, flows, and macro sensitivity. Several market reports released within the last few hours point to profit-taking after the early January rally as a key factor. Bitcoin had pushed into an area of prior resistance earlier in the week, and as price stalled, traders began locking in gains. That selling pressure, while modest, was enough to push prices lower in a market where liquidity remains relatively thin. At the same time, leverage played a role. As Bitcoin drifted lower, leveraged long positions began to unwind. This is a mechanical process rather than a discretionary one, but it tends to exaggerate short-term moves. As those positions were flushed, selling pressure briefly intensified before prices began to stabilize again. Analysts at JP Morgan described the move in today's note as a leverage-driven reset rather than a reassessment of value, pointing out that funding rates had been elevated heading into the pullback. From their perspective, cooling that leverage reduces near-term risk rather than increasing it. We apologize that we are repeating the same kinds of news from yesterday, but it is exactly what has happened again today. ETF flows are another important part of today's picture. Spot Bitcoin ETFs have seen renewed outflows, which added to the selling pressure during the latest move. Analysts at Bloomberg Intelligence have repeatedly highlighted that ETF flows have become one of the most influential short-term drivers of Bitcoin price action, particularly during periods when liquidity is lighter. However, Bloomberg's team has also stressed that ETF outflows should not automatically be read as a bearish signal. They note that flows tend to be episodic and sentiment-driven, and that outflows often follow rallies as investors rebalance or take profits. Taken together, today's pullback appears to be driven by mechanics rather than fear. There has been no spike in panic indicators, no disorderly selling, and no sign that liquidity has evaporated. Prices moved lower, leverage reset, and then the market began to find its footing again. And while we are talking about ETFs, a new development today is coming from crypto ETF flows, which are showing a clear shift in how institutional money is positioning during this pullback. Latest data shows that Bitcoin and Ethereum ETFs have seen net outflows, while some other crypto-linked products, particularly those tied to Solana, have recorded inflows during the same period. That suggests this is not a broad exit from crypto exposure, but rather a rotation within the market. Analysts following ETF data say this kind of behavior is typical during periods of consolidation. Rather than pulling capital out entirely, institutions often rebalance, trimming exposure to assets that have recently outperformed, while selectively adding to others they see as offering better risk-adjusted upside. What's notable here is timing. These ETF flow shifts are happening alongside today's intraday pullback, reinforcing the idea that the move lower is being driven by portfolio adjustments and positioning, not panic or a loss of confidence in the asset class. Market commentators have also pointed out that ETF flows have become one of the most immediate indicators of institutional sentiment. When flows turn mixed like this, it usually reflects caution and selectivity, not outright bearishness. So while Bitcoin and Ethereum have softened slightly, the presence of inflows elsewhere suggests institutional capital is still active, just more deliberate about where it's being deployed. Analysts at Goldman Sachs have noted that incremental expansions like this usually reflect internal confidence that client demand is durable and that regulatory conditions are workable. The key takeaway isn't that these products are imminent, but that traditional finance continues to build regulated access points even as markets pull back. Binance has confirmed it will remove 23 low-liquidity spot trading pairs as part of a routine market quality review. The exchange said the decision was based on factors including trading volume, liquidity depth, and overall market efficiency. Importantly, this does not mean the underlying tokens are being delisted entirely. In most cases, the assets will remain tradable through other pairs, but Binance is removing combinations that generate little genuine activity or are dominated by automated trading. Market analysts say this kind of cleanup is becoming more common as exchanges focus on reducing noise, improving execution quality, and limiting artificial volume. While these actions can cause short-term volatility in affected pairs, they are generally viewed as neutral to positive for overall market health. For traders, it's another reminder to stay aware of liquidity conditions, especially in smaller or less traded markets. Markets are also keeping an eye on developments in Washington, as the Supreme Court of the United States prepares to weigh a case related to Trump-era global tariffs. While this is not a crypto-specific issue, analysts say it matters because trade policy can influence inflation expectations, growth forecasts, and broader risk sentiment. Any ruling that affects tariffs could have knock-on effects across equities, currencies, and commodities, with crypto increasingly moving in step with wider risk assets during periods of macro uncertainty. For now, this is a background risk, not an immediate market driver. But traders say upcoming legal and economic decisions like this contribute to the cautious tone we're seeing today, particularly as markets balance strong recent performance against potential policy shifts. Now, I want to pause on a broader question that a lot of you have raised today. When global tensions flare up, wars, invasions, major escalations, markets usually react sharply. Risk assets sell off, volatility spikes, and safe havens catch a bid. So why is it that stories around Venezuela, Greenland, or similar geopolitical flashpoints haven't moved markets in the same way? I'll put this to you first. Do you think markets are ignoring these stories? Do you think they've already priced them in? Or do you think something else is going on? Here's what analysts are actually saying. Strategists at BlackRock have emphasized that markets react most strongly to events that are unexpected, immediate, and systemically disruptive. Large-scale wars or sudden supply chain shocks fall into that category. Long-running disputes or politically signaled tensions generally do not, unless they escalate suddenly. In the case of Venezuela or Greenland-related headlines, analysts point out that these situations have been well telegraphed, slow-moving, and, crucially, do not currently threaten global trade, energy supply, or financial infrastructure. That dramatically reduces their impact on asset pricing. Economists at HSBC have also noted that markets increasingly distinguish between political rhetoric and executable policy. Statements, positioning, and strategic posturing may dominate headlines, but they don't move prices unless there is clear evidence of follow-through. Some people ask whether institutions knew this was coming. There is no credible evidence to support that idea. However, analysts at Morgan Stanley Research have said that institutional investors tend to operate with longer time horizons and deeper scenario planning, which allows them to remain positioned through political noise rather than reacting emotionally. In other words, it's less about being in the know and more about not being forced to react. Right now, markets are far more focused on interest rates, liquidity, ETF flows, and leverage positioning. Those forces are doing far more to move prices than geopolitical stories that don't directly affect capital flows. That's why today's pullback aligns so closely with positioning data and ETF outflows, rather than with any specific geopolitical headline. Bringing this all together, despite a day full of stories about pullbacks, ETF outflows, and macro caution, the market behavior itself remains relatively orderly. Prices have dipped, but they haven't collapsed. Liquidity has tightened briefly, but it hasn't disappeared. Buyers have stepped in where you would expect them to. Analysts at Coinbase Institutional summed it up earlier today by saying that recent price action reflects digestion rather than distribution. In plain terms, the market is taking a breath, not exiting the room. So when you look at today's headlines as a whole, the intraday pullback, ETF flows, corporate accumulation, expanded institutional filings, and muted reaction to geopolitical noise, they all point to the same conclusion. This is a market that is resetting position, not repricing its long-term outlook. Volatility remains part of the equation, and short-term moves will continue to happen. But the structure underneath today's price action is very different from what you see during genuine market stress. That's where we'll leave it for today. Drop your thoughts in the comments. Let me know what you think is driving markets right now. Make sure you're following the show, and if you haven't already, please consider rating it 5 stars. And as always, we will see you at the top.